Welcome to Building Wealth with Rajiv. Here's my chat with Gautam Vaid. Gautam has written The Joys of Compounding, the passionate pursuit of lifelong learning, which touched many hearts and became one of the best sellers. Gautam and I talked about his investment principles, how he chooses companies to invest, and what makes him super bullish on India. Hope you enjoy the interview. Please do share your comments and follow my channel for such meaningful discussions. Hey Gautam, thank you. Really appreciate you giving time. I think you're a popular man now, and your time is really scarce.
I
Uh, s- so book, it was a massive hit, and I keep hearing in Singapore, some people keep posting on LinkedIn saying it's one of the best books they've written in investing. Now, I think I told you that I'm not going to talk so much about the book, but let's talk about it and say what do you think made it popular, Gautam? What are you hearing? Why did it resonate so much with people?
think in terms of the impact of the book per copy sold, it probably ranks right up there with some of the most influential books ever published in the field of finance. I'll tell you why. So there are certain books which sell a lot of copies, give a lot of knowledge. But I think what differentiates the joys of compounding and what has led to its big success in so many countries is that it has really touched the hearts of so many people. It has touched the chord of many people, and there is a reason for that. So when you open yourself up to the public, when you make yourself well, when you actually share your vulnerabilities, when you're very authentic, when you're genuine, people love to root for you. People love to root for the underdog. Many people know, my story of struggle in the US. I know how I basically left a good paying job in India to pursue my passion in the US, struggled for many months, finally landed up with a very good job, and then eventually achieved success through the stock market. I think many people took inspiration from that story, and that's actually also shown in the book. Just being authentic and honest about my mistakes and my learnings along the way. I think that is what a lot of the readers have appreciated. So this love and respect and admiration from the readers, I think I personally believe that's my most prized asset today. It's not the money which I've made from the stock market. It is this love and respect from people around the world who have read the book and have got to know about my story.
That's amazing. Now, so what? I think you've taken a bit of a unconventional path, Gautam, isn't it? I mean, you've educated so much, and what was the inner desire? What was that trigger point in you that you worked in a shipyard or something? I don't know for 9 months to get some knowledge, and you read books, and what was the inner desire?
It was not a shipyard. It was actually a graveyard shift
Yeah,
at a
yeah.
hotel in San Francisco, California, for 15 months. For those who don't understand what is a graveyard shift, it runs from 11 p.m. at night to 7 a.m. in the morning. And the reason for working in such a job for so long in America after relocating there was that I was very, very particular and very firmly adamant that I'm not going to go back to my previous field of investment banking. Many people, when I worked in that field for 7 years in India, London, Hong Kong, I was making good money. But many people, even today, in many countries in the world, confuse job satisfaction and happiness with earning a high salary income or a high job income. Happiness does not come from just earning a lot of money. It comes from doing work which gives you meaning in life, which gives you fulfillment. And thank God, in hindsight, it was a very good decision for me to get out of that field as fast as possible because people were just not understanding how much I was suffering from inside internally mentally in that particular job. So I didn't used to enjoy that field of work at all, but I was making good money, and people from the outside just used to think that, oh, Gautam is making a lot of money in his job, he must be very happy. But that's not how actually life works. Life is basically you find happiness in life when you live a life which is aligned with your value system, with your
Mm.
belief system, and with your likings and preferences. And that is why financial independence is so important, because it allows you to live the life that you want. It doesn't mean just material or conspicuous consumption, or buying luxury cars and gadgets. That's not the point. The biggest advantage of which financial independence offers to you is it gives you flexibility, options, the freedom to do what you want, with whom you want, for as long as you want, when you want. There is no limitations on your way of living your life. You can basically live life as per your inner scorecard.
Okay, that's amazing. What Warren Buffett also talked about, the inner scorecard, right? Now, I think I'll come to the financial freedom part a little later, Gautam. Let me just dive into your investing philosophy. Tell me about your fund. What's your fund about? You're running an India fund, right?
Yes.
And
Yes.
what is that, and how's that working?
So Stellar Wealth Partners India Fund is a Delaware-based investment partnership modeled after the original Buffett partnership fee structure. I charge zero management fees, and I get compensated only for returns that exceed 6% per annum. And very you will rarely find such an equitable fee structure in the hedge fund industry today. And there is a reason for that. Most hedge fund managers want to charge a hefty management fees because, like Charlie Munger says, all fund managers love the comfort of receiving a monthly or a quarterly or an annual paycheck. They want the certainty of the
Hmm.
income. But it's only when you're financially independent and pretty rich by yourself that you can afford to have a zero management fee structure in which you get compensated only and only on performance. You're not basically you're not getting paid for just breathing. You're getting paid only when you deliver very handsome returns to your investors. And also, there's one more very important point which I would like to make here, that skin in the game. It's very important for fund managers in this business, because the moment you have your majority of your personal liquid net worth invested in your fund alongside that of your limited partners, a complete transformation and sea change in your attitude towards risk management follows as a result. And incentives drive everything in the world. And when your incentives are aligned with that of your investors, then investors get assurances from two things. First of all, because the fund manager's money is invested in the fund, he'll aim to maximize returns as much as possible for his own benefit as well. And because the fund manager's own money is invested in the fund, he'll also be careful, ultra careful, not to blow up. And he'll be conservative at the same time. So basically, investors get the best of both worlds. You get return maximization along with risk minimization. So you get both these attributes when the fund manager has got skin in the game.
Amazing. Now let's go deep into the fund, Gautam. What's the mechanics? What are you buying? What's your investment philosophy? How are you choosing? So let's talk broadly. How many stocks, and what industry, and I just because that would probably reflect your investment philosophy as well, right?
Correct. So, as per a study published in the international bestseller, A Random Walk on Wall Street, it was shown that as the number of stocks in a portfolio approaches 25 to 30 names, you have captured all of the benefits of diversification, yet the number of stocks you need to know thoroughly is still manageable. So, in Stellar Wealth Partners India Fund, and in the small case which I run in India, both of them have got 25 stocks each. And this is the appropriate number which suits my personal temperament. See, in the initial years of building wealth as an individual investor, many investors tend to be very concentrated. But after they have become financially independent, then you want to preserve your purchasing power,
Hmm.
keep up with inflation, and you're ready to compromise a bit on the returns, but you want a lot of steady compounding over the long run.
Safety.
You're
Hmm.
not swinging for the fences anymore. You want
Hmm.
so getting rich is difficult enough, but staying rich is an art by itself. And staying rich is the part which requires the highest amount of discipline. This is why
Yeah.
Warren Buffett says that we don't have to be more smarter than the rest. We just have to be more disciplined than the rest. And
Hmm.
this discipline aspect is very important when you're running public money. You can't afford to blow up. There'll be many times when you'll be underperforming because your style is not in favor, because your investment philosophy is not in favor. The market takes off on its periodic speculative fervor. This is the time when you want to just avoid being sexy, avoid being very fancy. You want to just focus on doing the boring, simple stuff. Just
Yeah.
being disciplined and being true to your value investing philosophy. And value investing does not mean buying damaged or businesses in decline cheap, because those are value traps.
Hmm.
Value simply means getting more than what you're paying for with the least amount of risk. That's it. All
Yeah.
this bucketing of value investing, growth at a reasonable price, cyclical investing, turnaround investing, special situation investing, new age technology investing, all of these are simply different versions of value investing. At the end, everyone is trying to arrive at the
Find
same thing,
value in something.
find value in something. That's it. So at Stellar Wealth Partners, my investment philosophy is built on two fundamental pillars: variant perception and long-term structural trends. And variant first, let me talk about variant perception. So variant perception refers to situations where you get earnings growth coupled with return on capital employed (ROC) expansion, which results in valuation re-rating, and you end up with multi-baggers. And variant perception comes from having a differentiated view on the short to medium term trajectory of a
Okay.
business. And there can be multiple triggers for variant perception, starting with number one, product mix change in a higher margin category, because that can lead to operating leverage. Your profits grow faster in relation to your top line growth. That's the first thing. Number two, deleveraging. So as debt goes down, interest cost goes down, net profit goes up, market cap goes up. Also, because debt is a part of capital employed. So as debt goes down, your capital employed goes down, ROC goes up, you get valuation re-rating. That's number two. Number three, industry cycle shift. So the Indian residential real estate cycle has turned around after almost a decade. And we have had many multi-baggers coming from the building material space since then. So industry cycle shift is number three. Number four, changes in government regulation. So since early 2020, the government of India has put a heavy thrust on ethanol blending. And as a result, you've had many multi-baggers coming from the sugar mills and distillery space. Number five, operating leverage, which can come from having high unutilized capacity just at the beginning of an industry upcycle. That can also lead to very disproportionately fast net profit growth. Next, we have improvement in asset turns. Number six, you can get this information from managements on conference calls. You can ask them what is the expected turnover on the new fixed asset capacity. Now, ROC expansion comes from two things: high margins or improvement in asset turns. And between the two, I prefer the latter because high margins tend to attract competition. Now we have number seven, corporate actions. Corporate actions include demergers, promoter and management change, merger arbitrage, divestiture of a loss making or a non-core business segment. Multiple triggers for variant perception, which I've shared with you right now. And the second pillar was long-term structural trends. Long-term structural trends are found in industries with a very favorable structure. They're organized like a monopoly or a duopoly or an oligopoly at best. And they're characterized by some form of an industry tailwind. They have a long runway for growth ahead, and they have visibility of cash flow, free cash flows for many, many years ahead. They are also characterized by value migration. So in India, for the last 20 years, we have had value migration from public to private, from unorganized to organized, from offline to online. And there are multiple structural growth plays in the Indian stock market today: contract research and manufacturing services, affordable housing, music streaming, fintech, digital transformation, cloud computing, specialty chemicals with critical application. Multiple mega trends are in place. This is where the bulk of the portfolio in the India fund lies, which provides for steady compounding. And then you have 20-30% of the portfolio in variant perception plays for tactical alpha generation. So, in simple terms, you can call it a core satellite portfolio approach. But having this investment philosophy very clearly, tightly buttoned down in place, and having very lot of clarity around the kind of opportunities and the areas you want to look at, this is what leads to that discipline factor which I was talking about. That you want to basically stick within your circle of competence and look for opportunities within these specific areas which I just mentioned. And if you simply stick to this particular framework, there'll be no dearth of opportunities at any point of time. At the end of the day, there is only two fundamental principles for value creation in the world, and in any stock market in the world. The only two fundamental principles of value creation exist. There are two kinds of companies in the stock market: one with low returns on capital employed, one with high returns on capital employed. And for the companies with low returns on capital employed, the maximum delta, the maximum rate of change, the maximum intrinsic value creation takes place when they move from low returns on capital employed to high returns on capital employed. So those companies should focus on improving the returns on capital. Those companies are found in the variant perception framework. And for companies with high returns on capital, they should focus on improving the revenue growth, because that is when the maximum delta, the maximum rate of change, the maximum intrinsic value creation takes place for such companies. And those companies are found in long-term structural trends. And for more details on these two fundamental principles of value creation, the viewers should every viewer should read Motilal Oswal's 23rd annual wealth creation study, in which they've actually explained the mathematics and the arithmetic between how this phenomenon actually works for these two kind of companies.
Okay, so your my face is jammed again, but as long as you can hear me, it's okay. I'll edit it later, Gautam. I'll put the photos and all that nicely. So Your so talk about a couple of key holdings, Gautam. Is that of your fund? Is that and why they are there? Let's pick one, which is the top holding at the moment.
The top holding at the moment, now, full disclosure, I hold this stock in my father's account, in my small case portfolio, and in my India fund. And the top holding as of today is the merger arbitrage play, Equitas holding. And if you know Equitas, for every one share of Equitas holding, investors will get 2.31 shares of Equitas Small Finance Bank. And if you simply look at the stock price of Equitas Small Finance Bank and multiply that by 2.31, you'll notice that there is an arbitrage of more than 10% on based on today's prices. And on top of that, Equitas Small Finance Bank is anyways very cheaply valued. So once this merger is completed, 21st December is the record date for getting the NCLT approval for this merger. After that, once the merger is recorded and the merger is approved and the merger is completed and the overhang of this regulatory formalities are out of the way, investors can also benefit from the valuation re-rating of Equitas Small Finance Bank in the future as well. So individual position sizing in a portfolio or a fund at the end of the day is a function of the risk and reward. How much, what is the ratio of the expected reward to the risk that you're taking, and the bigger and more favorable the risk reward ratio, the bigger you can bet on the individual stock.
Yeah, and currently, how much does it make of your portfolio? 5%, 3%, 4%?
Initiated this position with a weighting of 5.5%. After the recent 30% run, now it's 7% of the portfolio.
Okay. All right. And I think let's just extend it further. What is the second holding? I think
The second holding is basically right now work in progress. I plan to sell a stock from the fund next week, and then no, the next holding is also a merger arbitrage play, again in the small finance bank play, which I would not like to discuss right now, but it will become the
okay.
second biggest holding at 6% weight.
Okay. Now, what Gautam, the curious thing is that you're a US citizen, right? And
Yes,
now I think you're kind of traveling all across the world, and you were in Singapore also, and then in India, you lost India fund. What's the reason for that?
it's simple. So, bulk of my personal net worth has been made in Indian equities over the last decade, and I'm a very big firm believer in the India growth story. And as of today, it is one of the best times for any investor in the world to have an exposure to the equity markets of India. And I'll explain to you why. Because all the stock market investors are very ardent students of history. And history teaches us, if you look at the history of the economies and stock markets of US, Japan, and China, when those three major economies' GDP doubled from 2.5 trillion to 5 trillion, their stock markets did not just double, their stock markets tripled or even quadrupled. And why did that happen? It's because when a nation transitions from a low income per capita country to a middle income per capita country, the basic spending on items like food does not go up much, but the spending on branded discretionary consumption and financialization of savings, these two categories explode. Today, India is at $3.3 trillion of GDP. And just let's go back 3 years in time when India was $2.5 trillion of GDP and just observe how this phenomena of financialization of savings is playing out right in front of our eyes during India's journey from 2.5 trillion to 3.3 trillion. 3 years ago, the number of demat accounts in India was 3.5 crores. Today, the number of demat accounts in India in just 3 years has more than tripled to 11 crores. So we have added more demat accounts in the last 3 years than in the previous 30 years combined. We've added many more. And this is that phenomena of financialization of savings, that category is exploding right in front of our eyes. Also observe what is really prospering in India over the last 2 years. It is branded discretionary consumption. Rural India is struggling, but urban India is thriving. Branded discretionary consumption, that those categories are basically booming. Footwear retail, wedding retail, fast fashion retail, all these aspirational yet affordable categories, the spending on those categories is just going through the roof in India. And this is where we as investors and fund managers should position our portfolios to enjoy the long-term compounding from these categories.
Okay. And particular sectors you're bullish on, Gautam? I get a sense of banking being one of your key one, right? Because top two holdings, you talked about the bank. What are other industry you're focused on, or you're bullish on?
I'm bullish. Apart from the current, currently India is, in the middle of a very sweet spot as far as the credit cycle and the banking industry is concerned. One of India's leading bankers, Uday Kotak, recently mentioned that we are witnessing a Cinderella moment in India's banking industry, because what has happened is, after 2016's big bank reform of the insolvency and bankruptcy code, in the last 6 years, the Indian banking system balance sheet has been cleaned up, and now they are primed to lend again. And we know from history that one of the biggest drivers of GDP growth in any country is banking system credit. So all these banks are now embarking on a fresh credit cycle with all their balance sheets cleaned up. So that is why I'm very bullish on lenders in India. Small finance banks, non-banking financial companies, the traditional plain vanilla private sector banks. Very bullish on that category. Apart from this industry of lending, I'm also very bullish on auto and auto ancillaries, because for the last 2 years, because of the semiconductor chip shortage and supply chain disruptions, a lot of pent up demand was built up in the auto industry, and auto also falls in branded discretionary consumption. Certain automakers are actually coming out with vehicles and products which are very aspirational in nature, and those are the auto players which I have basically included in my India fund. So those are the auto companies, auto OEMs, which have pricing power. Their vehicles and products have got waiting period of many months ahead, because there's huge amount of demand and not enough supply. And I'm also invested in a few auto ancillary companies, because this auto ancillary companies also tend to enjoy a much more higher level of operating leverage, and they tend to outperform the auto OEMs during an auto upcycle. Because when a low margin business goes from low margin, from suppose a company goes from 3% margin to 6% margins, the earnings growth basically witnesses a sharp percentage increase. But it's much more harder for a 30% margin business to double its margins to 60%, right? So that's why generally auto ancillaries tend to outperform the auto OEMs during an upcycle. So auto and auto ancillaries is the second category. The third category, which I'm very bullish on, is domestic manufacturing, or manufacturing exports, because after a long time of, or more than a decade, capacity utilization across corporate India has crossed 75%. This is generally the capacity utilization level when corporates embark on a fresh capex cycle. Also, in the last 6 years, a lot of corporate India has delevered their balance sheet, and now again they are primed to embark on a fresh capex cycle. And third, because of the incentives given by the government of India in the form of PLI, or production linked incentive scheme, a lot of corporates are getting a lot of financial incentives from the government to embark on a fresh capex cycle. And fourth point, in September 2019, India cut the tax rate for new manufacturing companies to just 15% to make it globally competitive in manufacturing. So there are multiple tailwinds which are in place for India to embark on a fresh capex cycle. So very bullish on domestic manufacturing as well. So lenders, auto and auto ancillaries, and domestic manufacturing.
Very well thought out, Gautam. Very impressive. I mean, how you're trying to bring the trends together and capex cycle, and then what is more relevant in that. Uh, you particularly more passionate about small caps, right? Or is there a particular reason for that? Just because the appreciation chances are higher, multi baggers can be made faster in is a market cap thing. Is that the reason, or is it you understand you're passionate about the entrepreneur driven companies? What's the reason?
I think even you can find this entrepreneurial spirit even in the large cap companies. It's not just limited to small cap companies. In fact, the base rates of success in small cap investing is much more lower. If you want the safety of large caps and the high growth of small caps, a much more better approach is to take a blend and invest more in the mid caps, because generally by the time a company reaches a mid cap stage, it has got all its process systems and processes buttoned
In
up,
place.
line very well established, and the
Right.
risk of the company going extinct is much more lower compared to small cap and micro cap. So I used to be much more small cap oriented when I was investing in my personal account. But when you're managing public money, it's better to take a much more blended approach. So in Stellar Wealth Partners India Fund and the Stellar Wealth Small Case in India, both of them I follow a multi-cap approach. So I've got a good healthy blend of large caps, mid caps, and small caps.
Okay. And uh, the macro environment, doesn't it bother you, Gautam? I mean, we're having this, every day I wake up in morning. Look, I'm invested in US market mostly, Gautam. And I know I've heard your views on Nasdaq, and I'm invested in Tesla, QQQ, Nvidia, most of the tech, my core competence. Now, how does that translate into India? Does that bother you for India as well, Gautam?
There'll always be something to worry about in the world at all points of time, all throughout our lives. So I think, like Buffett and Munger have taught us, they have made their best purchases when fears about the macro were at its peak. Now, if the US technology sector is crashing, how does it impact a high quality branded wedding retailer in India? Weddings are a secular long term growth theme in India, right? Irrespective of whatever happens in the world, weddings will keep taking place. Similarly, just whatever is happening in Ukraine or Russia or China, how will it impact a very high quality branded footwear retailer in India? People will still go out and buy their branded footwears, right, in
Yeah,
India,
yeah,
irrespective of
yeah.
what is happening in the world. All this noise, like I call it, is just getting amplified by social media, Twitter, Telegram, WhatsApp groups, other social media channels, Facebook, Instagram. We are just bombarded with so much information all the time that information age is no longer even present in today's world. What's really important, the most durable and sustainable edge for an investor today is the behavioral edge. Today, an investor's edge is less about knowing more than others about a specific stock and more about the mindset, discipline, and willingness to take a long term view about the intrinsic value of a business. No, and in fact, louder the noise, the better it is for long term investors like us. And again, let me clarify here. When I talk about long term, I'm not talking about just being stuck in a stock for the long term because things change very rapidly. I'm simply talking about remaining invested inside the stock market for the long term in a good portfolio of stocks. You have to differentiate there's a big difference between a great stock and a great business because the great businesses can also get absolutely overvalued from time to time, right? That is the time you have to be dispassionate and you have to take profits off the table and invest into a much more better opportunity. All that matters at the end of the day is your long-term CAGR, post taxes, and brokerage expenses. That's it. Everything else is just noise all around you. You have to be realistic, practical, objective. And the quality of all the great investors in the world is that they embrace reality for what it is, not for what they wish for it to be, hope for it to be, or want it to be. So this is how you become successful in the world of stock market. Just embrace reality for what it is. Just don't do wishful or hope investing.
And what do you tell yourself, Gautam? How do you keep yourself sane? Of all this noise. How do you keep yourself grounded? What you tell yourself? What's the story you tell yourself?
I simply ask myself, will this particular macro event or development affect the industry fundamentals of the company that I'm invested in? If it doesn't affect the industry fundamentals at all, then I stay put. But let me give an example here. So in November 2016, you had the case of demonetization in which 500 and this high denomination currency notes in India were basically banned. They were no longer in use. And there is an industry of microfinance in India which is primarily cash based. So that entire industry got disrupted. So because I knew that this particular industry was going to get disrupted, I was able to take action and sell out of my all my microfinance stocks which I held at the time. Those stocks crashed 50-60% after that. So as long as any macro event does not disrupt your industry fundamentals, then you should just stay put. That's it. And sometimes because of supply chain disruptions which took place earlier this year because of Russia Ukraine. Now, these short term supply chain disruptions often give us good opportunities to buy into high quality stocks at cheaper valuations because when those high quality businesses disappoint for a quarter or two because of these supply chain disruptions, the stock market is so impatient that hammered down the stock 15-20% or even more in some cases. But the long-term intrinsic value has not gone down by 20%. It may have gone down by just barely 2-3%, the long-term intrinsic value. But you're getting the stock price 20% cheaper. So as a long-term investor, this is how you gain an edge over competition, just by taking a longer term view than the rest of the others in the market and buying into these good quality businesses at cheaper prices. So investing is not that difficult actually. It's very simple, but it's not easy as well because we just tend to make it over complicated unnecessarily.
I mean, that's with everything in life, Gautam, right? We tend to overthink. We tend to, you know, make, I think, a lot 1x becomes 10x in our minds, and that's how we respond. Now, tell me, Gautam, you were a retail investor once, right? When you achieved your financial freedom, now you're investing people's money. What you left, what you gained more? How's your evolution like? How's it different for you?
It's very, very different. So I keep telling people that there is a world of difference between managing your personal account and managing public money. When you're managing public money, the two most important things you have to focus on is quality and liquidity. Liquidity in terms of average trading volume. Because when you're managing your own personal account, you can basically even go down the quality curve at times and get away with it because you can exit very fast. But when you're managing public money, you're accountable to your investor base. The last thing you want is you want to buy questionable corporate governance or questionable managements in the hope of making a quick buck. And then when that stock blows up, what will you tell to your investors? You're accountable and you're answerable to the public, right? That time when you're managing public money, this is why you tend to be more conservative. You are much more focused on quality of business, quality of management above all else, and you're managing public money. And also because these hedge funds are kind of are basically pool funds, you basically also want to ensure that the average trading volume of securities that you're purchasing, it's pretty good. Because when you're facing redemptions during a bear market or a market crash, if you try to sell those illiquid stocks in your pool fund, then the impact cost becomes very, very high. So you have to pay close attention to the average traded volume and the liquidity of the stock as well. So managing public money is a much more mature version of managing your personal portfolio basically.
And when you managed your personal portfolio, Gautam, how many stocks did you have?
Around 10 to 15 at all times, broadly speaking. But when I'm managing public money, now I have between 20 and 25. This is an approach which basically helps me sleep peacefully at night.
And when you had 10 to 15 in a personal portfolio, was it uh, highly concentrated towards a few? It tends to get that way, isn't it?
Yes, yes. So basically, that's how a typical portfolio looks like on a personal level. It basically becomes unbalanced over time as your winners concentrate and become the bulk of your portfolio. So at one point of time, I remember during 2017-18, a stock named HEG had become a disproportionately large percentage of my personal portfolio by value. But when you're managing a personal money, you tend to try to swing for the fences. You take excessive risks. You cannot afford to do that with public money. You are much more conservative. So for example, in my India fund and in my small case, I will never let a single stock, even though I will let my winners run, I will not let a single stock become more than 20% of the overall portfolio by value, because I do not want a single promoter or an industry to determine the life outcomes for myself or my investors. So there's a fine this is a fine nuance and a fine difference between your personal money and managing public money.
And what is the return you're targeting for your India fund, Gautam, if I may ask you? Do you have something in mind?
So basically around 15 to 20% on a portfolio level over the long run is what my expectation for the India fund is over the long run. And
Long,
and
long
trust,
run defined by 5 years, 10 years?
over the next 2 decades, I'm saying, like,
Okay.
generally anything less than 3 years is very short term, but this is a long term aspiration, and trust me, it's going to be very difficult to achieve it, because if you look at the actual track records of all the fund managers in the world, barely a handful of them would have managed to achieve 20% returns over a few decades. There are very, very
Very few.
barely, barely a few of them in the world. This is why, 20% seems very easy on paper. It may be achievable in the first few years, but being able to do it sustainably over the very long period of time, It's very, very difficult. I mean, making returns of 50 to 100% for 2, 3 years is great, but
Mm-hmm.
making 20% for 60 years is what makes a Warren Buffett. He,
Mm-hmm.
he played the game for the longest period of time and he became the biggest winner.
And Warren Buffett remains your favorite investor, Gautam, or you the one you look up to, or there's somebody else?
There are so many: Warren Buffett, Charlie Munger, Peter Lynch, Phil Fisher, Howard Marks, Chuck Akre, Terry Smith of Fund Smith. From India, we have got Ramdev Agarwal, Bharat Shah. There are so, and Joel Greenblatt also taught me special situation investing. He's also very, very good. So there are so many different varieties and approaches to value investing. And I think we should try to learn from the legends and just try to finally adopt the process and the approach which suits our personal temperament. The best investing strategy is the one which you can stick with for the longest period of time. That's it. The best investment strategy is the one which you can stick to even during the toughest of times. During bull markets, it's very easy to stick to your philosophy, but it's during periods of underperformance or during bear markets, that is when your investment philosophy and approach will be really strongly tested. So this is the approach that I advocate to people, that just stick with what you can stay with for the longest period of time.
Yeah, I think a couple of questions more before we call off. One thing, you kept talking about intrinsic value, Gautam. And I've seen some of the videos of Warren Buffett talking about what intrinsic value is, obviously discounted, the cash flow, and obviously he doesn't do it on paper, right? But how do you go about to a simple retail investor thinking of intrinsic value?
I'll share two white papers with the audience. If they
Yeah.
simply just read those two white papers, they'll understand everything there is to know about, just understanding valuation at a very broad level. So the first is, what does the P multiple mean? It's a paper by Michael Mauboussin.
Mm-hmm.
The second white paper is the P ratio, a user's manual by Epoch Investment Partners. Just read these two white papers and you'll understand how to approach valuation, what should be the right valuation for a business, what is the justified P multiple for any business. It's simply a function of the return on invested capital and the expected growth rate in that business. That's it. And all else equal, a higher ROIC is more desirable, but the same cannot be said for growth, because if a business which is earning less than its cost of capital tries to grow very fast, it destroys shareholder value. So just don't focus on growth above all else. Focus on the spread or the excess or surplus of the returns on capital over the cost of capital for a business. And I would rather prefer a business with 30-40% return on capital employed and growth of 15-20% rather than the other way around. Because if a business tries to grow faster, much more faster than the sustainable growth rate, then it will have to resort to either debt financing or equity financing. So that makes the balance sheet much more fragile and vulnerable. So I would rather have slow and much more steady growth over the long run than basically I would rather have a marathon. I would prefer a marathon than
Mm.
a sprint, basically.
Okay. Now, and what do you think about these Wall Street estimates, Gautam? Are you a believer in those?
I read research reports only for summary information on a company, nothing else. I don't even look at the numbers, to be very honest. I just look at the report to get a basic overview of the company, nothing else.
Okay. And the India story, which you're so bullish on, Gautam, and many people are. I mean, I've been hearing. I just want to hear, possibly this is last question, India versus US. I mean, US is a big market. If you, Google, Apple, all of them come from US, right? We still have to see anything coming from India of that magnitude, right? So if you look at these two markets, where does India's story tie up?
I think after the crash in the Nasdaq stocks and all the tech stocks, value has now emerged in US tech. Investors should, while being bullish in the India story, should not ignore US tech anymore. I think now you're getting really truly world class great businesses at much more reasonable prices and valuations which make sense. No stock recommendations here, but look at Apple, Amazon, Google, Facebook. These are free cash flow generating businesses available at a much more reasonable valuations now. And I think there are many other pockets within US tech which investors should also evaluate. Be very selective though, because generally, all these tech stocks were the leaders of the previous decade bull market in America. And history has taught us that after every after every bear market, new trends emerge. This is why new sectors may assume leadership in the future, but still look selectively for pockets within US tech. As far as India is concerned, I think the next, for me, I'm very clear. The big investment idea for the upcoming decade is India, without a doubt. Just like I bought the India investment opportunity to investors in America through the India Fund, now I'm working on creating an investment vehicle which will allow investors from all across the world to participate in the India opportunity. So I'm working towards that investment vehicle as well. A formal announcement may be made soon, but I think it's my personal conviction and belief that all investors in the world should have some allocation to Indian equities in their portfolio, because this is just too big a wealth creation opportunity which you should not miss. It's very simple. It took India almost 60 years to reach its first $1 trillion of GDP, but it took India just 7 years for the second trillion. And these subsequent trillions are expected to be reached in much more faster succession. And if we simply assume the market cap to GDP to approximate one over time, one can just envisage the kind of wealth creation that lies in store for investors in Indian equities over the next few decades. Trillions of dollars. We are talking trillions of dollars here of wealth creation. And who will capture the bulk of this upcoming wealth creation boom in the Indian stock markets? The nation's best managed businesses with proven ability to scale up their operations and execute. They'll capture the bulk of this upcoming wealth creation boom. This is also known as the power law. This power law exists in every stock market in the world. You look at the US. As per a study published by Professor Bidenberg from the University of Arizona, between 1926 and 2016, in those 90 years, only 4% of listed US equities accounted for 100% of the net wealth creation in the stock
Mm-hmm.
market.
That's true.
Phenomena is basically playing out in India as well. Between 1990 and 2018, only 1%, only 1% of listed Indian equities accounted for 100% of the market cap addition. Just 1%. This is what makes active investing so tough, but highly rewarding at the same time. This is why most active fund managers fail to beat the benchmark or the frontline indices, because it's not an easy competitor. It's very difficult because the headline index, what the beauty of that index is, they basically keep adding winning businesses, and basically all the
They're the best fund managers that way.
exactly, they keep deleting all
Yeah.
the poorly performing businesses. So this is how a good investor should also operate. You basically water the roses and cut the weeds. But we investors tend to do the opposite. We add more to losers and keep
Yeah.
profits in the winners. We do the exact opposite.
Gautam, my personal one example I'll give you. I've not been investing so much in Indian equities. You have 5 more minutes?
Sure, sure.
Yeah. I don't, I've not invested so much in Indian equities, but let's say property market. I bought some properties in India and I bought, the exchange rate for Singapore dollar versus INR was 25 that time. And they increased in the value, but at the same time, my dollar value, $1 became 50 INR. So I lost 50% of I lost about 100, the dollar value against the rupee became half. So even if the property doubles, it's still same for me. So I think that big exchange rate fluctuations issues I've seen in India, and I think that's what sometimes scares me to invest in Indian equities also. That if I sell back and bring back money to Singapore, what would it be worth?
The
You have a
simple,
view on that?
sure, sure. So the simple solution to that is, if you generate, you have to target a much more higher rate of return, at least 20% plus in local Indian currency terms. Because even when I talk to investors in US, I tell them since 1st January 2014, the annual depreciation in the rupee versus the dollar is 3.1%. And that is what you should expect, even over the long run. Even though people keep talking about a demise of the dollar, decline of the dollar, I'm not in that camp. As long as the US dollar is the reserve currency of the world, I believe it will keep on appreciating gradually and steadily against the Indian rupee over the long run. But you have to budget for that in your return expectations, and plan your return targets accordingly. That's why I aim for 20% returns at a gross level in rupee terms, because then only the returns for a US based investor or other global investors make sense. The fund manager has to. India is a growth market, right? So India is a country in which you have a real GDP growth rate of 5-6% and inflation of 5-6%. So you're having a nominal GDP growth of 11-12%.
Yeah,
You
which is much
have,
higher.
you have a natural tailwind basically, just being given to you. You can comfortably expect the stock market or the index to at least keep growing at double digits for the long run. So with a little bit of skill and value add, a fund manager can actually aim to earn 20% returns over the long run. It will require effort. It's not easy, but it's doable if you actually put in the hard work.
Okay, amazing. Now, last question. You grew up on Tesla's, Amazon, Netflix of the world, right, Gautam? Did you expect them to become such a hot or darling or such successful stocks? I mean, they've all had disruptive businesses, long tail, right? I mean, look at Tesla. I mean, it was company was about to get bankrupt. Amazon wasn't making any money. Netflix cash flow issues. Did you expect them? Because if you look them through the lens of value investing, did you expect them to be so big? Are you surprised with that? And what are the learnings for you from that?
Very surprised. Never expected them to become so big. Otherwise, I would have invested some money in these stocks which you mentioned. I have not invested in either of them, neither Netflix, nor Tesla, nor Amazon. I'm much more conservative by nature, so I look at very highly profitable businesses like Google, Microsoft, Apple, etc. But yeah, I missed. Basically, I think those 10 years were very very tough for traditional value investors, and many of us have grown up learning from Buffett and Munger, who have always avoided tech. And look at which has been Warren Buffett's biggest stock investment winner in his career. It was Apple,
Apple.
in which he made more than $100 billion. So, Warren Buffett, even at this age, is such a fierce learning machine. And that is what we should try to learn from both of them, just to keep our minds and ears open and always, have a flexible learning mindset and to not avoid any industry completely. I mean, who would have thought that in the last year, energy stocks would have done so well? All stocks were completely written off. Energy was completely written off, but they've done so well. So all these sectors go through their own cycles. The investor just need to have an open mind and embrace, what is working at the time and adjust accordingly.
And you're not a believer of technical analysis, are you?
A little bit. I don't use it extensively, but I do use it uh, you know, for some of my sell decisions and cyclical stocks. So a very simple way to exit a cyclical stock in which you have made 2x, 3x in a short span of time is, whenever the stock breaks its 21-day moving average or 50-day moving average, basically you take your profits off the table. That's a simple way to have a sell decision on a cyclical business, which I've used a couple of times. But whatever method you use, the key to long term success will be to have the discipline to stick with it and not to use your personal judgment or discretion. Don't disturb the system. Once you have set up a system in place, stick to it. If you're using technical indicator for your sell decision, then just be very very disciplined and stick to it. That is basically how you'll be able to be very consistent over the long run.